Hi, everyone. Thanks for being here with us today. I'm Jane Maddox, partner in our tax practice and real estate construction leader at Anders. We're presenting today with David Seibel from McGuire Sponsel. McGuire Sponsel is a longtime partner of Anders. We've worked with them for probably close to 20 years on our tax credits and incentives group. And as you've probably seen and heard, the new R&D rules under the One Big Beautiful Bill that passed earlier this year has created a lot of questions, especially around Section 174, documentation, and what the IRS is now expecting of us. So again, we're fortunate to have David here with us. He's nationally recognized R&D tax credit specialist who works with companies across a wide range of industries to build defensible credit claims, strengthen documentation processes, and proactively adjust strategies in response to evolving federal and state requirements around research and development credits. Today, David's going to walk us through what's changed, what we should be looking out for, and how to approach credit claims going forward. Again, we work closely with McGuire Sponsel, and we are happy to have David with us. So with that, I'll turn it over to David. Thanks so much.
All right, thanks, Jane. Yeah, as Jane said, I'm from McGuire Sponsel. Appreciate the opportunity today to speak to Andrew's clients. So again, like Jane said, McGuire Sponsel partners with CPA firms throughout the country, including Anders, to help enhance the offerings that the CPAs can offer their clients. So we do this through 4 practice lines. We have our fixed asset group that specializes in cost segregation, property tax, and fixed asset management. The R&D tax credit group, where we focus on state and federal R&D tax credit studies. Our global business service primarily does transfer pricing studies and international tax compliance and IC disc work. And then finally, our location advisory services that specialize in site selection and incentive procurement. But like Jane said, today's focus is going to be specifically on R&D with the passage of the One Big Beautiful Bill, kind of talking through the research and experimentation costs that can now be deducted with the passage of the the passage of the One Big Beautiful Bill. Talk through some of the transition rules and options available to taxpayers on the 24 returns if those have not yet been filed, and then also 25 and going forward. Some things to think about today in terms of tax planning for 25 and beyond as it relates to research and experimentation costs, as well as the R&D credit. Then we're going to shift gears a little bit toward the changes to the Form 6765, which is the tax form that is used to calculate the R&D tax credit. So there have been changes since that were implemented in 2024. We'll go through some of those changes, as well as what may need to happen on documentation standpoint to make sure that you're set up for success to address these changes to the 6765. And then finally, we'll finish with an update on some state R&D credits, including Missouri, but also some other ones as well. So first, update on Section 174, which is the Research and Experimentation Tax Code provision. So as we know from the Tax Cuts and Jobs Act, companies were required to amortize their domestic R&D costs from 22 through 24. But with the passage of the One Big Beautiful Bill Act, that full expensing for domestic R&D expenses is now allowed again for tax years beginning after December 31st, 2024. With that, there's also some transition rules that allows taxpayers to be able to accelerate and recognize some of those remaining unamortized deductions, or possibly be able to deduct them in full on previous returns, which we'll go through those rules in a little bit. But it's also important to note that this expensing rule only applies to domestic R&D. Any foreign expenses that had to be amortized over that 15-year period under the Tax Cuts and Jobs Act will still be required to be amortized over 15 years going forward under the One Big Beautiful Bill Act as well. So it's just important to note that this expensing provision is for domestic R&D costs only. With that, there is also the option to still capitalize and amortize those domestic R&D expenses. If there is a company out there that perhaps wants to continue to do that, that is still very much an option. It's not required to be expensed going forward. So that is still an option that taxpayers can choose to utilize. And then finally, with the passage of the One Big Beautiful Bill, This is related to the R&D credit, but the 280C election reverts back to its prior treatment pre-Tax Cuts and Jobs Act, meaning that any taxpayer that's claiming the R&D credit will have to either reduce their deductions by the amount claimed or instead take the 280C election, reduce their credit by the maximum corporate tax rate, and take a reduced credit instead. So quick example, if a taxpayer claims $100,000 in credits, they would either have to deduct that $100,000 from their deductions, so essentially raising their taxable income by $100,000, or they can take the 280C election, multiply the credit by 79%, which would be $79,000, and then wouldn't have to reduce their deductions in lieu of taking that haircut on the credit. So that's something that, again, was something that was prevalent pre-Tax Cuts and Jobs Act 2021 and prior. That 280C treatment is going to be coming back for those tax years beginning after December 31st, 2024. So there are a few transition rules that went along with this one code section 174A creation, which is for that domestic research costs. First is that small taxpayer provision. So you essentially are able to apply this new code section 174A that allows that full deduction, those full deductions for domestic research costs to tax years 2022 through 2024. So rather than applying it 2025 going forward, basically make this election and it can start to be applied to 2022 and going forward. So with that, that becomes the ability to amend those returns from 22 through 24. But in addition to that, the 280C provision will kick in as well, but taxpayers will be allowed to make a late 280C election, even on those amended returns, which are normally, a 280C election can normally only be made on a timely filed, originally filed return. But this was a special exemption that was made for those years. All other taxpayers, that 174 amortization provision still applies for 22 through 24, but there is still some options for relief. So taxpayers can, if they don't want to do the small taxpayer provision or perhaps are not eligible, they can also choose to accelerate their unamortized expenses for the 22 through 24 periods on that first return for the tax year beginning after December 31st, 2024. And they can choose either to spread it over that 1 year, so take it all in 2025, or spread it out over 2 years for the 25 and 26 years. Something I neglected to mention for the small taxpayer provision, a small taxpayer in this case is defined as a taxpayer that has averages under 31 million in gross receipts for the 22 through 24 periods and is not considered a tax shelter. And it's also important to note that this small taxpayer provision has to be elected either by the earlier of July 6th, 2026, which is 1 year date of enactment of the One Big Beautiful Bill, or the 2022 statute date, if that's something that was filed on time. So it's the earlier of the two to make sure that you're able to apply that for the 22, 23, and 24 years for that small business election. So with that in mind, what is something that taxpayers, clients should be thinking about today as we're gearing up for this 2025 tax season? First is to evaluate your options. So left side here, you'll see that the small taxpayers, they basically have three options. They can elect that small taxpayer provision and go back and amend the 22 through 24 returns. It's important to note that this is an all or nothing election. So it's not a situation where you can pick and choose to do 23 and 24 but ignore 22. It's because of the way the election works, 22 through 24 has to be addressed, meaning that all three of those returns would have to be amended. Now, something that is important to note, if the 24 return has not yet been filed, so if there's a fiscal year end client out there with a 9/30 year end, still have your 2024 return that's not filed and you want to elect this, but you don't want to amend returns, there is the possibility to fully expense the 2024, the 174 costs on the 24 return, and then also kind of do what they call 481A adjustment to catch up on those 22, 23 expenses on that 24 return. And that eliminates the need to amend those returns. Again, this is not the small business election is not something that's required for taxpayers in this situation to do. It's just an option available. What they could do is they could instead choose to then accelerate their deductions in 25 or the 25 and 26 period, or they can continue to amortize the 22 through 24 174 costs as well, while they can still choose to expense the 25 174 costs, research costs going forward. Again, any of those options are available for those small taxpayers. For large taxpayers, again, they have to amortize for 2024 because that 174A provision doesn't kick in until the 25 tax year, but they can still utilize the accelerated deduction provision for the 25 or 25, 26 years. Or again, they can continue to amortize the 22 through 24 174 costs until those are fully done and exhausted on their amortization schedules. Something that additionally for taxpayers that maybe have not claimed the R&D credit over the last couple of years, it's something that can still be done. So if a taxpayer has not, for one reason or another, claimed the R&D credit for the 22, 23, and 24 years, that should be part of the discussion, part of the equation to when you're thinking about going back and amending these returns, whether you elect the small business provision or perhaps haven't done 174 in the past for the past couple of years for one reason or another. Still an option that can be done, some maneuvering that can be done to make sure that you're still in compliance, acknowledge those 174 costs in the past. Again, for small taxpayers, the play there would likely be you could elect out of 174 and then make that 280C claim to claim those credits as a small business. But there's also options, as we'll get into a little bit later, for large businesses to still be able to amend, also to claim the credits for the 22, 23, and 24 years, while still addressing 174 in those years as well. As far as the timing goes, taxpayers can start amending returns for the R&D credits right now. They can start amending for the 22, 23, and 24 years, and then address any 174 parts in 25 and going forward. But particularly, it's something that needs to be planned for now, especially with some of the decisions that need to occur from a 174 perspective. So if you're someone out there who's looking to maybe think through like they're eligible for the small business election, trying to think through, okay, does it make sense to amend the returns for 22, 23, and 24, or do we try to utilize everything on the 25 return, or maybe continue to amortize the 22 through 24 174 costs? What are some things that we should be thinking about? And this is certainly not an all-inclusive list, but it's something, all points to consider to be able to determine if amending the returns makes sense. I would say from this list, concentrate probably more on the left-hand side of the list, as these will probably be the more relevant factors, but certainly the right-hand bullet point list is important as well. So just to touch on some of these real quick, the first two, the tax rates for 22 through 26, as well as the tax liability for 22 through 25. And obviously 26, we're not going to know until that year happens, but if you're able to project out what that liability might look like in 26, that would be great too. But essentially think through, okay, what was the actual tax liability for those years? Does it make sense to go back and amend the 22, 23, and 24 years to claim those 174 costs fully on those returns to generate those refunds? Or if there is that tax liability in 25, does it make sense to just take those remaining unamortized deductions and put it all in 25? Might help you recognize a refund sooner, lower your tax liability for that 25 year. Another factor is any entity or ownership changes during the 22 through 25 years. I know us personally at McGuire Sponsel, we talked through these scenarios as they occurred. Oftentimes in an entity or ownership change, that 174, a company, particularly if they're doing a stock purchase, the 174 costs were staying with the company. And so any agreements, any purchase agreements most likely had those 174 costs those future deductions baked into the cost of the sale. So again, looking through those agreements, seeing how that was addressed might be a factor in determining whether a taxpayer, whether a company is going to go back and amend those 22, 23, and 24 returns. Another big factor is the number and the cost of the amendments for those tax returns. If you have a situation where you have a company that's going to be wants to amend the returns, but there's 10 partners or 10 shareholders, that's a lot of returns. Obviously, a lot of costs involved, a lot of logistics to be able to amend those returns. So that has to be considered as well in the cost benefit analysis. Finally, the last two, timing and interest income for refunds. If you're someone that doesn't necessarily need the money right now, that you can go back and amend those returns and wait. We've all seen the news about the IRS and kind of the staffing issues there. Typically, what we're seeing is that it could be up to a year, or maybe sometimes cases even longer to be able to get those refunds. So the timing of those refunds has to be a consideration as well. If you need the money quicker, maybe again looking to those accelerated deduction provisions. If you have the tax liability, might make more sense. But at the same time, if you don't necessarily need the refunds, the money at the moment, you can always amend the returns, and then there's going to be interest income associated with those refunds as well. And then finally, state implications. So there's a lot of states out there that have different conformity amendments and how they approached 174. So just making sure that those are in alignment with any type of amendments that need to occur is going to be critical to make sure that you're in compliance with those state requirements as well. So kind of looking forward, as we're going through the 25 tax planning year, 25 tax season, here's a little kind of guide decision tree that you can walk through to really check your options as it relates to the research expensing of 174 as well as the R&D credits as well. So the left-hand side is for taxpayers that have amortized their research costs, which we've already covered in previous slides, so I won't go over them now. But the right-hand side is for taxpayers that maybe for one reason or another, again, did not amortize their 174 costs. What options are available to them? So if they are a small business and they're in that left side there, they have a couple of different options. They can either take the small business election and then amend the 22 through 24 credits or tax returns to claim the credit as a small taxpayer, and then elect to just fully deduct those 174 expenses on the amended returns, acknowledge that there were 174 costs there, basically switch the expensing from the 162 or whatever that might have been to that 174A. The trick caveat there, little stipulation is, again, that is an all or nothing election. So 22, 23, and 24 would have to be amended not necessarily all together, but would have to be amended. There wouldn't be any picking or choosing that would be allowed there. Or the other option, which again, this would be the option that's also available to large taxpayers as well, is to amend to claim the R&D credits for the 22, 23, and 24 years. And then what you do is basically file a change of accounting method to acknowledge those 174 costs that occurred in the 22, 23, and 24 years, and then utilize that accelerated deduction provision to basically create a net zero 481A adjustment, or basically a no change in the 174 treatments. So helps you from a compliance standpoint and still allows you to amend for those 22, 23, and 24 years, while also being able to pick and choose which years you're amending, because in this situation, it would not be an all or nothing election. If 22 or 23 doesn't make sense and you only want to amend 24, or you want to amend 22 and 24, but not 23, that would give you some flexibility there. So with that, we've reached the end of the 174 treatment. I'm checking the chats here and want to see if there's any questions out there about 174 before we moved on to the R&D credit and some of the changes with the reporting requirements. So if there's any questions, give it a little bit of time for any people to post anything in the Q&A section or the chat before we move on to the R&D credit portion. Okay, I don't see anything popping in here. So, Jane, you're seeing the same thing?
I was just going to say there's no Q&A, no questions, but feel free as we go through the presentation. I should have mentioned this at the beginning of the call, but you're welcome to submit those anytime and we'll address them, whether it's during the presentation or at the end of it. So we welcome all questions. Thanks.
Okay, so we will now go on to the kind of the new reporting requirements for this 6765. So one thing to note, these changes did originally start for the 2024 tax year, but the calculation methods, the qualifying criteria of the R&D credit, the four-part test, if you've heard of that, the qualifying expenses of wages, supplies, contract research, computer leasing, all of that is still the same as it has been in previous years. What really changed now is the detail required for those originally filed returns, because previously the form 6765, the R&D tax credit form, was a two-page form that was very high level. It was as should provide the total qualified expenses incurred for the year, as well as some of the base year information to ultimately calculate the tax credit that was generated for that year. But now we'll see as we go through some of these slides, there's a lot more detail that needs to go into it starting in tax year 2024. We'll go into a little bit reason why this is the case and why the IRS started to request some of this information. And it's also important that some of these portions are optional for 24 and going forward, and will be optional continuing for certain small businesses, but certain sections will all be mandatory for companies starting in 2026. So first, ultimately, how do we get here? Just to give a pretty quick introduction of this. So this memorandum that was issued way back in 2021 was the IRS wanted taxpayers to provide additional information for R&D credit claims for refund. So if a taxpayer was going back and claiming the R&D credit, generating a refund, the IRS wanted additional information to verify this information. This is a situation where, yes, the client or the taxpayer is qualified for this credit, and we can issue a refund. So originally, when this memorandum was released, the taxpayer had to identify all the business components to which the credit related to for that year. So every project that met that four-part test and had associated costs for that claim year, as well as identifying the research activities performed, naming the individuals who performed the research, and also identifying the information each individual sought to discover, and then providing the total qualified employee wages, supplies, contract research costs for the claim year. Later on in 2024, they actually removed the requirements for naming the individuals and the information each individual sought to discover. But we'll see in a little bit that last information each individual sought to discover actually makes its way back into the new 6765. So the IRS started seeing the credit claims that were coming in and said, hey, we need some additional information. This original two-page form, the 6765, is not providing us the information that we need. So this really started setting the groundwork for them to start making some of these additions for subsequent tax years, again, beginning with that 2024 tax year. So a few additional requirements for the 6765. The first one is this new section E. There's 5 questions in section E. 2 of them are value inputs. So if one is naming the number of business components for the tax year, and that's, again, would be any new or improved product, process, technique, formula, invention, or computer software that had qualifying costs in that year, putting down the total number of those for the tax year that's being claimed. And then the next one, entering the amount of officers' wages included as QREs. This is a big thing for exam. Oftentimes, is the IRS wants to know how many QREs, how many qualified research costs are associated with an officer's wage. That's not to say that those are illegitimate costs or anything, but it's something that is a focal point because typically, when you think of officers, they're generally working on the business. They're not necessarily working on research. But as we know from lots of small, medium-sized companies, a lot of officers are still very much involved in research. So again, the IRS just wants to know how much of the QREs that were claimed are associated with the officer's wages. And then there's also some additional yes/no questions. Lines 39 and 40, did you acquire or dispose of a major portion of a trade or business, or are there any new categories of QREs claimed for the tax year? That's for the consistency rule. So basically, when you're calculating the credit for the current year, you have to use the base years as a comparison. The IRS wants to know, was this a fair apples to apples comparison? So, for example, if you acquired a business in the current tax year, they want to be able to, you have to make some adjustments in the base years to account for what those costs might have been in the base years to, again, making sure they're making an apples to apples comparison. Line 41 is more for larger corporations that have certified financial statements. Again, there's this safe harbor ASC 730 directive that companies can use as a starting point to claim the research credit. But it's generally reserved for larger businesses, again, with those certified financial statements. And this is just to determine, again, it's a yes or no question of whether this particular taxpayer followed that ASC 730 directive. Okay, so that one, not really too hard in terms of the burden that's required to fill out Section E. This next section, though, Section G, this is where it's going to throw a lot of taxpayers, a lot of clients through the loop because of the required detail that needs to go into Section G. So what Section G is requiring is the information related to each business component. So I mentioned before the prior 6765 was just a high level, how many costs were incurred by the taxpayer for the year. Section G, clients have to start reporting that on a business component level. So some of the information required for Section G, naming the project as well as what type it was from a business component standpoint. Was it a newer, improved, again, product, process, technique, formula, invention, computer software? Second part is the information sought to be discovered. I mentioned that it was replaced from those amended return claims, but makes an appearance here. Important to note that only needs to accompany amended returns, doesn't need to be on an originally filed return. And then finally, breaking out the QREs by business component. So breaking out the total qualified wages, not even just the total qualified wages, but also breaking out the direct research, support, and supervision. Those buckets they're eligible, as well as the cost of supplies, computer leasing, contract research. All of that needs to be split out by business component. Finally, it's important to note that Section G you only have to report 80% of QREs or no more than 50 business components. So if you're in a situation where you do 100 projects a year, you would only have to fill in the top 50, as well as if you have those 100 projects, but maybe the top 5 comprise 90% of the qualified research spend, you'd only have to fill out Section G for those 5. So obviously, it's going to be a little bit more of a heavy lift for taxpayers, particularly if they have not tracked those expenses in this way for their research credit studies. Something important to note, though, is Section G is optional for all taxpayers on the 24 and 25 returns. It was originally scheduled to be mandatory for 25, but just this past October, the IRS is giving it more time, still incorporating feedback that providers have provided on the new 6765. So Section G will be optional for every taxpayer on the 25 return. And then going forward for 26, it will be required, but there is a small business safe harbor where it is optional for any taxpayer that's claiming a payroll tax credit offset, which is generally a startup company, or a taxpayer that has both annual qualified research expenses of 1.5 million or less and less than 50 million in annual revenue. So it's an and situation if both of those conditions have to be met. If you're a $100 million company and you only have $500,000 in qualified research expenses, you'd still be required to fill out Section G. So obviously, like I said before, this is going to be a pretty heavy lift for taxpayers, particularly those that have not maybe tracked the information in this way in the past. But thankfully, 2025, again, it's optional, but with 26 right around the corner, this is a good opportunity to be able to really focus in and try to establish some processes to contemporaneously track some of this information throughout the year. That way makes summarizing the R&D activities this time next year a much easier process. So we're just going to go through a couple of those strategies now. First off, this might sound really simple, but developing that list of business components that are kept through the year and keeping it contemporaneous throughout the year. So identifying, was it a new or improved product or process? What was the project objective? And then also, most importantly, having just one singular list. I know this is an issue when we conduct our research credit studies, is maybe one employee might call a project one name and someone else might call it another. Creates some confusion, creates a little bit of complexity. Just having one singular list that's kept makes it a much easier process. Second step, connecting people and the projects. So who worked on the projects, how much time did they spend on it, and then also, were they directly involved in the research or were they a support or supervisory function? If you're out there and you have a time tracking system, that's great. That helps a ton. You're practically 90% of the way there. Maybe there's a few adjustments that you need to make to determine if there's direct research support or supervision, but being able to connect people to projects and then how much is pretty much all the way done. If you're not someone who has a time tracking system, what do you do then? Then it becomes an exercise of what cadence does it make sense for employees to just jot down how much time they worked on a particular project. For example, if you're out there and you have 5 engineers and they maybe work on 3 projects a year, that can maybe be a monthly or quarterly exercise for them to say, I worked on this project X amount of time, and I worked on this project Y amount of time. But if you're in a situation where you have 100 employees that are conducting qualified research and 1,000 business components that are worked through the year, then it becomes a little bit more complex. And that's where, again, that cadence of, does this need to be more of a weekly or biweekly exercise, make more sense. Ultimately, there is no one size fits all solution. It has to be what makes the most sense for your business. Another big thing is tying supplies to projects. So contemporaneously documenting materials to the projects and as well as documenting the experimentation that took place. I know I have a client that keeps all of their costs in an R&D account. It's very great. When we looked at their research, we're doing their R&D credit study last year. We kind of walked through, okay, what do we need to be able to comply with Section G? Because they would have had to comply with Section G in 25. So again, they were 90% of the way there. Then they took the step to add an additional field to be able to tag the projects that were conducted throughout the year, where again, this time next year, it'll be a much easier process to be able to tabulate. These are the costs that were spent on these projects. Again, if you don't have that, if you don't have an R&D account, what can be done to be able to track those costs contemporaneously through the year so that, again, you don't have to try to recreate everything from scratch this time next year. Similarly, documenting contract research. documenting the invoices to projects, particularly for any contractors that may be working on multiple projects. Just being able to split that time when that invoice is received or when it's paid, just to make it an easier process during the year. Um, so this slide, just want to go over some potential pitfalls to avoid. Won't go through all of these, but just a few ones I really want to highlight. From a business component perspective, having a high volume of projects with low QREs. So an extreme example of this is if you had 1,000 business components, but only $100,000 of qualified research expenses. That's not a very it's a pretty low ratio of dollars to business components. In an exam situation, the IRS might question, well, how much experimentation really went into this if there's not that much cost associated with it? So again, making sure that you're able to group business components together where it makes sense, where it's appropriate. If there's a family of business components or components that can be grouped together into a subassembly to reduce the number of business components that are claimed. Again, if that is an appropriate thing to do, if it makes sense, that's something to keep in mind is that number of business components and that ratio of QREs to projects. Another thing I wanted to touch on was development versus implementation, particularly from an artificial intelligence standpoint. This isn't necessarily related to the new 6765, but it is something that we're fielding a lot of questions on is just artificial intelligence. Obviously, that's the thing that the big buzzword right now, something that everybody is looking into, whether they're going to incorporate that into their processes. The big thing that you have to keep in mind with artificial intelligence is what is the development versus the implementation. So if you're just going through and checking to see what artificial intelligence can maybe do for you, if you're just exploring it, if you're doing something that's an out-of-the-box solution as it relates to artificial intelligence, that type of thing does not necessarily qualify for the research credit. But if you are looking at artificial intelligence, trying to see how it can maybe connect some of the systems together, and you're starting to delve into those technical uncertainties and there's an experimentation process, that's where it starts to make sense to say, like, okay, this is a qualified research project. But again, just merely exploring AI or just seeing what it can do for you, that's not necessarily going to raise to the level required to be able to claim it as an R&D project. Wage QRE concerns, particularly claims that are largely built on officer wages. Again, not necessarily that officers can't be included in the research credit, but there has to be strong substantiation for those officers' wages, particularly where those officers are a little bit more highly compensated. Say they're the owner, but they have that engineering background. It's still fine to be able to claim them as a qualified research expense, but the main thing is going to be having to have that documentation in place to substantiate their involvement, because that is something that the IRS is going to look for, and something they're going to question are those officer wages, particularly if those officer wages contribute a substantial part of the qualified research expenses. And then finally, excessive amounts of supply QREs is a red flag. We actually work with a former IRS engineer who spent, I think it was about 30 years in the service. He mentioned to us that that was one of the things that they looked for in research credit studies, research credit claims, was if the supplies were more than the cost of the wages. So the rationale being that typically the R&D credit is going to be a wage-driven credit, and if there's more supplies that are in the research credit study than wages, that might signal that those materials might have been more from a commercial production standpoint versus an experimentation standpoint. Again, not necessarily that that's going to be an automatic red flag every time and that every claim that has that is going to get audited. But they are going to take a second look at that and check on the industry, see if those claims make sense. Okay, finally, now that we're kind of reached the end of the 67, 65, I'm happy to address any questions that, if anybody has any questions on that, check real quick. I don't see anything before we just finish up with some of the state credits.
I think you're good, David.
Okay, all right, we'll move right along then. Like I said, just want to touch on a few state credits. First of all, there are a few new credits from an R&D perspective. A lot of states offer their own R&D credits as an incentive on top of the federal credit to encourage innovation within the state. Missouri and Michigan are two states that have recently uh, revamped their R&D credits after having them lapse over the last couple of years. So Missouri's, they reinstated theirs beginning for tax year 2024. It is an application-based credit with a $10 million cap. So if there's a situation where the amount of credits claimed exceeds that $10 million cap, then it is prorated, depending on the amount of the claims. And this is a program that also prioritizes small businesses as well, that enables small businesses to be able to claim a larger share of the credit and has a special pool carved out for them. I will say that the application deadline for this is September 30th. So any taxpayers out there that are in Missouri that are conducting research in Missouri, you'd be able to apply for the 25 credit in 2026 by September 30th. But the Missouri credit in particular there's a lot of compliance work that goes in with the application. So something that is best not left to the very last minute to try to get everything done in one day, because some of the documentation that's required, um, some of the supporting documentation that has to be submitted with the application generally cannot be turned around in one day. So you just need to make sure that you plan for that appropriately. Michigan, they've introduced a new, very generous credit starting in 2025. It's a refundable credit with $100 million that are allocated toward the program, similar to Missouri credit. If there is more than $100 million of claims, then they'll prorate it as appropriate. But it is a refundable credit, which is very generous, to encourage innovation with that state. And something that's really important to note for the Michigan credit is it is also, like I said, an application-based credit, but the turnaround time for that is very tight. So to be able to apply for the 25 year, that application due date is April 1st of 26. So any taxpayers out there that are listening that have Michigan qualified research expenses and you're interested in claiming the R&D credit for that state, just keep in mind that there is a very tight turnaround time for for that application, particularly for those taxpayers that typically extend. Because again, for an application-based credit like Missouri and Michigan, once you're past that application due date, unfortunately, there's nothing that can be done because they want to try to generate those credits and distribute those credits to the taxpayers to be able to utilize it. So no late applications are allowed on that. And then two other states that had some upgrades and how they're dealing with research and the research credit. Texas earlier this year revised their credit to more closely adhere to the federal R&D credit rules. And so it's going to be calculated based on the amount reported on the 6765, but just for those expenses that are originated in Texas. Um, Also, supplies that are included in the 6765 can still be included in the research credit for Texas, even if they do get the sales tax exemption treatment. Something that was changed where previously Texas you couldn't include supplies that were subject to that sales tax exemption, but now you can. They also increased the credit rate too to make it a more generous credit for those taxpayers claiming qualified research in Texas. And then finally, California, they actually revoked one of their calculation methods that's, from a federal perspective, hasn't been in place since about 2008. and they instead introduced the ASC option, which is pretty common for a lot of states as well as federal as well. But something really interesting that they did was they actually rolled back their 174 treatment to pre-Tax Cuts and Jobs Act treatment. So meaning that taxpayers cannot just deduct their domestic research costs for California purposes, but they can also deduct their foreign costs as well, foreign research costs as well, which again, from a federal perspective, is still subject to that 15-year treatment. So that's kind of a conclusion on the state level incentives, quick updates on those. Jane, did you have anything else you wanted to touch on?
No, I don't think so. I think you've covered it all. Thanks a bunch. I know that's a lot of material to cover in a very short, condensed set of time. So, David, thank you so much for providing your expertise. Certainly to those on this webinar, we welcome questions, comments, anything that you might have. Feel free to reach out to myself, your advisor at Anders, if you're already working with one. Hopefully you've been in contact if the R&D credits are applicable to you and your business for 2024, 25, or any of the years as the tax law change is applicable to. So, David, I don't have anything else. I really appreciate your
Okay.
time. I didn't highlight McGuire Sponsel enough on the front end, so I'll just make one more plug here. Again, as Anders, we work with McGuire Sponsel very closely on a lot of tax credits and incentives. David highlighted a few different levels of those services that they can provide. This has been a huge benefit to many of our clients, as it allows us to keep our overhead costs and fees down by utilizing McGuire Sponsel for these particular strategies. So if you have something maybe outside of R&D that you're looking to implement, or you have questions on if it's applicable for your business, again, please feel free to reach out to us. We want to make the most of your money, save taxes as best as possible, and happy to be a partner along that. So with that, thanks a bunch. Happy holidays, everyone.
Thanks, everybody.